Are you wondering how to analyze a good stock? Many investors struggle with this at some point, and I mean, even when stocks are crashing, I've even found myself asking, is now the time to get in? And then when stocks are at their all-time highs, maybe it's too late. So how do we analyze stocks to find out when is a good time to buy? With metrics, that's how. In this video, I'm going to cover 7 of the most popular stock metrics that investors use to analyze stocks. But before I get into that, I wanted to introduce our sponsor for the video. It's Dividend. Dividend helps investors like you and I find high-quality income securities for their retirement and financial freedom portfolios. And the Dividend newsletter analyzes their top 10 high-quality dividend growth stocks each and every month. They do the work for you. Look, it's an excellent product. I use it myself to research companies for some other videos that I create here on the channel. So if you'd like to support the channel, go ahead and check out the Dividend link in the description below and hit the subscribe button while you're at it. Also stay tuned because I'll be giving you a promo code worth a $41 discount off their newsletter. Alright, so stock metrics get used to analyze, compare, and track the performance of stocks. These metrics are known as quantitative assessments. And both value investors, dividend growth investors, and analysts, well, they use them to get a bigger picture of how a stock is performing. Stock metrics are essential tools for picking stocks to invest in. Of course, now, metrics alone doesn't mean that every investment will be 100% safe and profitable, but using investment metrics as part of your strategy, well, it'll help you see if a stock is cheap or expensive, for example, if it's trading at a discount or a premium according to its value based on growth, profitability, and even its balance sheet. And in most cases, you're probably going to want to examine 2 or 3 or more metrics to see how a company compares against its competitors. Alright, so without further ado, let's dive into some of the most common stock metrics that investors should know and use to analyze stocks. Then, armed with this knowledge, hopefully the next basket of stocks that you pick will go on to be some big winners. Okay, so earnings per share tells us how much net earnings a company has for each share. For example, let's say you had a company with $100 in net earnings and 2 shareholders. Well, the company would be said to have a $50 earnings per share ratio. Now, let's look at this stock, Microsoft. Here, you can see the EPS, or earnings per share, is $9.39. And it means that the company makes $9.39 in net profit for each share that's issued. So the higher the EPS, the higher the company's profitability. Now, if a company loses money, for example, during a recession, well, the company could have a negative EPS. It doesn't necessarily mean that it's a good stock or a bad stock or that you should sell it or buy it, but it's important to know why the company is losing money and how management plans to turn the company around. Here, for example, we have WeWork. This company's earnings per share is actually a negative number. It's $18.38, negative. In other words, for every share that the company issued, the company actually loses $18.38 on an annual basis. That said, if the company can grow the business and cut its expenses, that EPS could turn positive and the stock could soar. Oh, and the EPS ratio is also an important metric to know when analyzing other stock metrics as well, such as the PE ratio. Okay, so probably the most famous of the investment metrics is the price-to-earnings ratio. The PE ratio is the amount of money that traders are willing to pay for each dollar of net earnings. For example, let's say you want to sell a small private company. Well, you'd likely get a multiple between 2 and 4 times your net annual earnings. And that multiple is the PE. But larger companies, the ones that have more revenue, durable competitive advantages, faster growth, well, they're almost always going to have higher PE ratios. To calculate PE, you take the company's current stock price and you divide it by the earnings per share. Here, let's take a look at Tesla. Here we see the stock is trading for $881.51. So if we take the stock price and divide it by the earnings per share of $4.90, well, we get $179.90. And you see, Yahoo says that the PE ratio is 179.86. Well, that's pretty close. There's probably a little bit of rounding issue going on. But anyway, look, investors benefit by calculating the PE ratio in a few ways. First, they have a better idea of how cheap or expensive the stock is. And second, they know what multiple an investor is willing to pay for a company's earnings. Now, PE alone isn't perfect. If you're going to use the price to earnings ratio to compare two companies, don't forget they have to be in the same industry. And all while expecting the same levels of growth in the future. Let's take, for example, Coca-Cola. Well, you couldn't compare that with Tesla. I mean, Coca-Cola has a PE of 29 compared to Tesla's PE of 179. And this is because Coca-Cola doesn't grow at the same rate that Tesla is. They're not even in the same business. But if you wanted to choose between Coca-Cola and Pepsi, for example, then comparing the price to earnings ratios would work much better. And here, with Pepsi, we see that the PE is a little higher at 31.85. Now remember, Coca-Cola's PE is 29. So checking the PE could be one way to see which company is better valued. Now, based solely on PE, let me know, which one do you think is a better buy, Coca-Cola or Pepsi? Let me know in the comments below. The next metric we have is the price to sales ratio, and it tells us exactly how much investors are willing to pay for every dollar of sales. The price to sales ratio gets calculated by dividing a company's stock price by its sales per share, or sometimes known as revenue per share. One benefit of using this ratio is that it helps you compare companies that cannot be judged based on earnings alone. For example, some growth companies or high growth companies may have negative earnings or they're losing money. It doesn't mean that the company is worthless. It just means they don't have a high earnings at the moment. The price to sales ratio lets you see if, despite those negative earnings, if they're still worth investing in. Additionally, some value investors also choose to include debt when calculating the price to sales ratio. Including debt when working out a company's market cap can provide a more accurate picture. And this is because one company may have high sales thanks to massive debts, but another company may have lower sales figures, but they're debt-free. Now, earnings do not always equal the amount of cash that is flowing into a company. Also, some accounting items, such as depreciation, can make a company's earnings seem higher or lower than they are. Looking at a company's free cash flow helps you see how much money the company is actually generating. Free cash flow is calculated by looking at a company's cash flow statement and deducting capital expenditures from its cash flow operations. The benefit of looking at a company's free cash flow is that investors can then understand why a company's price to earning ratio might look cheap or expensive. For example, let's say you were analyzing a stock that reported operating cash flow of $1 million. And in that fiscal year, the company spent $600,000 on new equipment. As a result, the company's free cash flow is $400,000. Now, working out the free cash flow can tell you a lot about the status of a business. A large amount of free cash flow shows that the company has plenty of money or how much the company has left over. And that excess money could then be used for other things, such as research and development, or stock buybacks, or even paying dividends. Okay, so the profit margin ratio is a company's net profit divided by its revenue. Using this investment metric can assist with how well a company handles its finances as it compares profit to sales. For example, let's say a company has $1 million in revenue and $100,000 in net profit. Well, in this case, the company has a profit margin of 10%. Now, dividend growth investors will use the profit margin ratio to determine how well a company converts sales into net income. For example, they'll want to know that profits are high enough to continue paying dividends. And if the profit margin is low, then this might suggest that expenses are high and could mean that dividends, well, won't get increased or worse yet, might get cut. Okay, so the dividend payout ratio tells investors the dollar amount of dividends that gets paid versus net income. You can calculate it by dividing the company's annual dividend per share by its earnings per share. The dividend payout ratio is a crucial stock metric for dividend investors so that they can use it as a way to help figure out if a company can continue to easily pay or even grow their dividend. Let's say, for example, a company has an annual dividend of $1 and they have $4 of earnings. Well, that would mean they have a payout ratio of 25%. And for a dividend stock, it means that the dividend is probably safe and there's lots of money left to grow the business. But if the payout ratio is 90% or higher, well, the dividend could be, well, it could be cut or reduced. Now, one area that often gets overlooked when looking at stocks is debt. Now, just like managing debt at home, debt or having too much debt can be devastating for a company, especially in the event of economic crises like recessions, geopolitical issues, pandemics, you know the type. Now, many companies that go out of business often have large amounts of debt. To analyze the debt-to-equity ratio, you'd calculate it by dividing a company's total liabilities by its shareholders' equity, and you're going to find that on the balance sheet. Different industries have different standards for acceptable levels of debt. Once investors know the debt-to-equity ratio for the given industry, they can then judge for themselves if the amount of debt is acceptable, or if it relies on excessive debt to fund its operation. Well, folks, there we have it. Using the investment metrics that I've spoke about in this video to analyze stocks will help build a better picture of your investments or potential investments. And the more you analyze stocks using your favorite metrics, the better you'll get at creating a sentiment. But like anything in life, nothing is 100% certain. If it were, we'd all be fabulously wealthy by now. You guys get the idea. Thank you so much for watching, and I'll see you in another video. Bye.